going to move on to our next story. I actually have a very special guest with us. It's real estate, our RE watchman, Sean. Sean, how are you, brother?
Good morning. Really
Good
grateful
morning.
to be here. Big fans of all three of you. So thanks for having me.
Thanks for being here, brother. And you guys may have watched Sean on my channel recently, but Sean's going to talk to us today about institutional investors essentially fire selling their single family residential homes. Now, this is a very big story because remember what we hear in mainstream media, that the housing market's resilient, that institutional investors are going to keep these houses forever. So the fact that these institutional investors, who again, their business is designed to hold houses, the fact that they're now fire selling properties, to me, it's a clear indication of two things. Number one, liquidity squeeze. Maybe the lag effect's finally catching up and they need money now. Number two, their assets are no longer performing, whether it be property taxes skyrocketing in Texas or competition, vacancy. There's many things, but I'm going to give it to you, Sean. And let me share your screen right here. And you guys don't forget, real quick, go to RE Watchman on YouTube, subscribe to this man's YouTube. He's got some great data. He's a great person. Sean, mic is yours, brother.
Thank you so much. And you mentioned we did talk about this earlier in the week. So I will add a lot of things that have kind of developed since then, but just to fill anyone in who missed that video earlier in the week, and also just give you a little background of where I'm coming from briefly. So I like to think of this as, where were you during the great financial crisis in the last housing bubble, right? So for me, 2008, I was in college studying social psychology and economics, which I think both come into an interesting interplay when you think about bubbles and behavior. We like to think people are rational in their decision making, but it's amazing how much emotion comes in, even to financial decisions, et cetera, et cetera. So, and then I bought my first property in 2012. And so whereas some of my neighbors paid prices in 2005 that wouldn't really recover for 10 years, I bought mine in 2012 at the bottom and it doubled in 4 years. So that was my experience in the last sort of housing downturn, to really be, able to kind of reap the benefits and the opportunity that came from that. And so as I relocated, I really started digging into the San Antonio housing market, had to leave behind my low rate in another city. And what I've found since then, just a lot of interesting things. The layers continue to be peeled back. And where I would start is, you mentioned some of the interesting kind of questions about, why does this matter, right? Why does this matter to me as a consumer, what these institutional investors are doing? The way I would frame it is, oftentimes when we talk about how housing has become so unaffordable, right? I know one of the studies says 80% of people can't afford, the 80% of homes, are unaffordable to the median buyer, right? And so people will often respond, well, it doesn't matter if homes are unaffordable because, investors will come swoop in and buy these homes, right? And you'll even see kind of a myth quoted. They'll say, well, BlackRock's going to buy them. Okay, well, BlackRock doesn't actually buy homes, right? They are a 6 or 7% stake in American Homes for Rent, a public company that does buy and rent out homes. But American Homes for Rent has now started selling them in Texas. So they sold 600 plus homes in 2023 after years of being a net buyer. So clearly there are shifts happening that are interesting to watch and try to understand, hey, what does this mean for me? What does this investor activity mean? And more than anything, I think try to push back on the notion that, hey, if homes are unaffordable for consumers, then these investors will just buy them, because what I think we're seeing is that they are no longer able to pass on those costs to a tapped out consumer in the form of higher rents. So if you look here, I think you can see the visual, right? We've got that pulled up. Yeah, I can see it. So the pattern that I'm seeing, you'll see these little icons. These are new construction neighborhoods built by Lennar, where First Key Homes in San Antonio bought 400 homes in the last 2 or 3 years. And so the little red icons are homes that First Key bought in these Lennar new construction neighborhoods. The blue icons are, I just call them individuals, people who own only one home, right? So it's owner-occupant properties. So these are not build-for-rent communities. These are communities where people moved in expecting to, buy into a community that was mostly owners. And institutional investors have bought a significant portion of the street. Well, you'll see in the yellow, these
Sean,
are now the homes for sale.
Sean,
Yes.
real quick, I just want to reiterate what you said to the viewers. I really want them to understand what they're looking at. This is very, very valuable, you guys, what you're looking at right here. This is such a huge story. He's showing you a brand new neighborhood. So what you're looking at, it's brand spanking new. It's the Lennar neighborhood. And you're looking at institutional investors mixing in with normal citizens. Everything in blue is a normal citizen. It's normal, more than likely, primary residence, owner occupied. But all of those red little dots are institutional investors that swoop in and buy clusters of these new homes. And the yellow dots is what you're seeing as far as those same institutional investors that wrecked the value and the neighborhood now saying, oh, we messed up and we got to sell. Is that correct so far, brother?
Exactly. You nailed it. So the yellow are essentially, I'm going to show you several of these neighborhoods to show you this is not just cherry picking one example, but what you'll see is that they purchased 400 homes across about 10 neighborhoods. And now in most of those neighborhoods, they are now selling homes. And so the question is why? It's so, soon since they purchased them. And there are a number of reasons contributing to this. But like you mentioned, I spoke to people in one of the neighborhoods, right? Homeowners. They weren't aware that an investor had come in and bought a quarter of their street. And when we talked about that, they said, well, I did notice there were some for rent signs that didn't go away for a long time. They were there for a very long time, right? And so as you we'll look into some of the history of some of these listings, but clearly the investor didn't have a grasp of what rents would go for. So rents were lowering. We're also seeing the investors now have much higher property taxes as inflation has been passed on in the form of those property taxes. And so the investors have higher costs, they're getting lower rents, and so now they're selling. And so the question is why, right? You mentioned liquidity. We'll get to all that, but I just want to show several of these examples here. So here's one example. Again, the red are the homes bought by the investor. The blue are just owner occupants. The yellow are the homes that are now being listed for sale only a few years after they purchased these large chunks. So here's one neighborhood, and this is all in San Antonio. Here's another neighborhood. You see a couple of yellow, in each of these blocks. You see a lot of red, a lot of investor purchases, but then also a lot of people who moved in there as families. Just a couple of more of these, just so that you see it's the same pattern. It's like a script. And so once you start digging into it, you'll notice just a few themes, right? Again, over and over again. One of the themes, obviously, is, Travis, you've talked a lot about, sort of the census and the revisions to their graphs on what new construction was selling for, and, the all-time highs, quote unquote, that have been revised. Well, this listing in particular is interesting in one of these neighborhoods where you see on the right, and I'm going to get more into this a little bit, how to look at property Central Appraisal District websites and see who owns these homes. But FKH, First Key Homes, you see they own all of these homes. And then on the left, you see, this home was listed by Lennar for $354 in 2022. First Key tried to sell it. They listed it originally below that at $315, and now it's dropped all the way down to $285. Right.
Okay.
And you could argue, okay, well, maybe they got a discount from Lennar's sticker price when they first bought. And okay, maybe they did. And Texas is non-disclosure, right? So I don't have access to what the actual sale prices were. But even if they got a discount, my point is a consumer likely paid the full price in 2022, right? Yeah. And if anything, the people I talked to shared the same sort of story that you hear, which is the narrative is, the incentives were in the form of rates, right? I get a lower rate on this house. I don't get any sticker price lowering. And so what happens is whether the investor bought them at that time at a lower price or they're definitely selling them now at a lower price, the implication is, essentially at some point, this investor is continuing to drop the price, and that affects the equity of the person who bought their home, right?
And Sean,
Yes.
For the viewers, I want to explain, because you just touched on the part of the story. I think this is huge. And for the viewers, just one more time, what he's showing you is that Lennar, it doesn't tell us exactly what it sold for, but going back to that Lennar where you're just at, Lennar could have sold the house to this institutional investor for $354,000. Okay, we don't know; it's non-disclosure state. Fast forward about a year and a half later, that same property is now being sold for well less than $354,000, now being sold at $285,000. And what I wanted to bring up, Sean, and you were kind of getting at this, I think this is brilliant. 3 comps and you're out. Not 3 strikes. Okay, this is my thing. Okay, 3 comps and you're out. The fact that these institutional investors are selling for, it appears, we need more info, but it appears for under market value, that is absolutely dooming the locals, because the way that appraisal value works, 3 comps. You got 3 comps that are being sold for under market value. Guess what? It's no longer under market value. It's now market value. So you need 3, boom, you just drop the market value. So can you see these institutional investors, by them doing this, do you think that it puts the existing homeowners in danger of price decline?
Absolutely. And, I think the other interesting element is they're also now competing with the builder to sell these homes, which is partly why they're probably dropping them by so much. But, someone who I really respect and appreciate their perspective and their content chimed in and said, well, how can you compare these, 2022 list prices to what they're selling for now? I mean, what if it's a home with 100 cats in it and it's, in bad shape? And, I'm thinking, okay, I don't know what the going rate is for the depreciation per cat calculation, but that would be a pretty high amount. If that's the case, I really need to get into the cat remediation business, because that sounds very lucrative. But the point is, okay, if they own all of these other homes on the same street, why would they continue dropping the price? Why wouldn't they just fix it back to to being at the level of where it was just a few years ago? And someone mentioned in the chat, yes, I think that is one of the possible reasons. You'll notice they have open protests on tax appraisals on these homes, right? So it gives them this power, where as an individual, if I want to protest my property taxes, I don't have another one down the street that I can just sell to kind of manipulate the value and then hopefully lower the taxes on 20 something other homes on the same street, right? They have this power from owning the number that they own that leads to, just some possibility for some questionable things. And so, and you mentioned it could be liquidity. We're going to get into that as well. I mean, I think there's, if you look at some of the headlines when it comes to REITs and things like that's a possibility as well. But either way, I think, I'm coming at it from the perspective of, I'm just a consumer, a citizen. I'm just asking the questions. I don't necessarily have all the answers, but one of the things that I am trying to do is equip people to go into potentially purchasing a home and be able to ask those same questions in your area, right? Because I think one of the things people will say is, oh, large investors only own a small percentage of homes in the US. And yes, that's true. But it's clearly not a small percentage of homes on that block, right? I don't care what the national statistic is. I care about the block that I'm actually trying to considering purchasing in. And so if we look kind of at just some other data points, I mean, if you look at the history, like I mentioned, it's just price drop after price drop on the rent. So what I think they did is they really just sort of mispriced what they thought they could get in terms of rent. And a lot of that has to do with the areas that they're choosing to buy in, which is a whole nother story that I'm going to be producing some content on. But essentially, when I was driving around one of these areas, I was looking for a coffee shop to plug my laptop in, and all they had was a truck stop McDonald's. Right. So they picked these areas that they thought, well, we can get cheap land and maybe they're up and coming. And what I really think happened is that out of towners moving in thought, oh, I heard this place was up and coming. Let me buy this home. But the locals really aren't interested in a lot of these areas. And that's what you've seen, in the video we had this past week, Travis. Someone said these are terrible areas. And that's the thing, is that I think national builders and then national investors had this idea of what was happening. And we'll get into this later. And some of that was very specific to, 2021, the pandemic, et cetera. And so they've had the speculation, and it turns out that the numbers aren't working out in their favor. And so you could also point to the builders' financials are doing great. Okay, well, how many of these homes are they selling to investors under the premise the investors are going to make money renting them? So the builders' financials look okay, but really it's sort of they're just passing it on, and we haven't, the builder hasn't really sort of in their financials faced that, well, maybe these homes aren't worth what they thought they were. So you see the rents dropping. I mentioned the taxes going up. And then here's another, like I mentioned, here's another interesting kind of tidbit is this is a street. I'm looking at the property appraiser website, which you can do. And, I want to do more of an in-depth how-to on how to do that. But you'll see at the top here, these are the homes owned by FKH, First Key Homes. I redacted the individuals' names just because I don't want to put anybody on blast here on a public video. But you'll see at the bottom, these are the Lennar homes on the same street, right? So it's really interesting to think that not only do you can't get the rents you expect as an investor, your property taxes are going up, and you're also trying to sell homes where the builder is continuing to build new homes and lots of them. And so you just have this situation where all of these factors, and there's even more factors than that. I mean, you look at the amount of building, this is a picture I took of all the different builder signs with a few little political signs mixed in there. But, you see all of these builders building in some of these areas that are, again, not really prime areas. They're further out. There's not a lot there. And, if you look at the appraiser websites, you see that the builders own way more homes than are listed. Many of them are just lots, or maybe they're not very far along in the building process. But the point is, if they're already not getting, these investors already aren't getting the rent they expect, what happens when you have many, many, many more sort of hitting the market? And so this is an example of where you see.
Sean, sorry, if I could just step in real quick. I just want to add, what's really important and kind of tying in the story that Travis did last week about the revision to the census numbers for, new homes and things like that, is that all of these builders use these assets for pledging to their facilities. So as Jack was talking about the dollar shortage, the collateral shortage, this is also going to create dollar shortages for these national builders who, let's say last month they had, thousands of properties listed at 350,000 and pledged to their warehouse facility. And then this month, those are worth 250,000. Well, what they're going to have to do is suddenly you're going to have a liquidity shortage event because you have less available cash than you thought. And you're continuing. So this is what happens. And this is how these liquidity shortages can just happen overnight. And people like Lennar, they have gone out into the market saying that they are not going to reserve cash. They're not building up a cash cushion. And so in this world of borrowing, they need these assets to be overvalued. And sorry, I just wanted to kind of interject that really quickly.
No, I'm so glad you did. And, I know I'm running out of my time slot here. I want to just kind of lightning round a few things before we close here. But, great point. And I'm so glad to have your perspective on this. I mean, just to illustrate here, Lennar, new home source, it says they have 736 homes. You go to the property assessor website, it says Lennar has, 2,500. So what are they going to do with them? And I've gone to some of these locations and have some video I need to edit, but it's amazing the amount of inventory. And what that leads to is, we talked about, this is an institutional investor here who, Tricon, who, I said yesterday, they're offering 2 months rent. Well, they've upped the ante. Now it's 6 weeks free rent plus 50% off security deposits. So they're finding, oh no, these numbers I thought I would get for rent, rather than lowering the sticker price. It's kind of like the builders. They're trying to offer incentives, hoping that they don't have to fully lower the price. But I think the discounts on even the sticker price are coming. And so, if you expand this story, I'm very micro focused on San Antonio. I saw someone ask about an area in Florida. I'm starting to look into more areas. And so an example here, this is First Key Homes in Cape Coral, who's getting a lot of press about their inventory and things like that. You see, this is the yellow being the first key homes for sale and the purple being the ones they've bought in the last few years since 2020. So they bought a lot and now they're selling a lot. And you could add any number of theories why that is, but even their listings here offer a little bit of a different flavor than San Antonio. Whereas here, I mean, in this particular example, they paid almost double for a home built in 2020 and 2022. Now, Florida, it will tell you what they actually pay, whereas Texas, it's obfuscated. But huge property tax increases. They overpaid for these homes because now they clearly, if you look at they tried to get a certain amount of rent, they had to drop it. So now they're selling tons of these homes just as the inventories are skyrocketing in these areas. Georgia, we're also seeing some of these institutional investors sell. So Texas, Florida, I'm also kind of looking at what are some of the next states to be part of this phenomenon. And so I've seen some Georgia examples. I know I'm out of time. We didn't even get into the build for rent, the apartment occupancy here being really low. There's so much to cover, but I really appreciate, just the platform and being able to be here and speak to you all.
Sean,
okay, so we got to
ahead.
be fast. We got to be fast because I got like 7 questions from the users, but I wanted to remind the viewers just real quick one more time. I saw you guys making fun of me in the private chat. That's funny. I wish I could show them what you guys are calling. They're calling me names in that private chat. You guys trying to mess me up. Anyways, you guys don't forget to go to real estate. Wait, that's not right. I apologize. Right here. You guys don't forget to go to Real Estate Watchman or RE Watchman. Subscribe to his channel. He's also on X and Twitter. So I just want to give you one more plug. But starting with Jack, can you guys quickly ask him some questions and then we'll go to the viewers.
Sean, fantastic. I am 100% aligned with the premise that the institutional investors are really in trouble here. And I've seen this for a couple of years now. I get comments on a lot of my channel that the government should do something, that we need to make it illegal for Blackstone to buy private single family homes. And my answer has always been the same. Don't touch it. Just these guys are going to learn their lessons. They're going to bleed money. They're overpaying for houses. And if people can't afford the rents, just like you were saying, then these houses aren't going to cash flow and these institutional investors are going to get wiped out. And as it happens, just this week, I got a private message from a viewer. And, I'm not going to break confidences or anything, but a major home builder in the United States is looking to offload several dozen neighborhoods, not houses, neighborhoods. Each neighborhood is 100+ homes. And the reason why they're looking to offload these thousands of homes, tens of thousands of homes, I didn't do the math, but is because they have a big interest payment coming up this summer and they don't want to make that interest payment. So these institutional investors that we've been saying, oh, they're victimizing us by creating this bubble, they're struggling for life right now because the interest rates are killing them on the debt to buy these homes. So how might they sleaze their way out of this, I guess is my question. Are they going to go hat in hand to the government for some kind of bailout or liquidity injection? Do they have an out here or are they just screwed?
Yeah, and I totally agree with you just on this from the standpoint, people have proposed laws to fix this. And I tend to be someone who says, to your point, the free market will work this out. I mean, I think I definitely don't support them being forced to sell their homes because I think that would be, we're already seeing inventories rise significantly even without that. So, from the standpoint of, I just think, like you said, the can has been kicked down the road. And I think they're starting to find out that some of these investments they made didn't work out how they thought. And so, I think just my main message is as consumers, just be aware of this and know what's going on. And rather than let's go try to create some laws to change what they can do, let's be more informed as consumers and know, am I moving into a neighborhood where they're going to, potentially the builder is going to have a lot of excess inventory and want to sell to an investor or want to sell at a deep discount relative to what I paid.
And Sean, we have about 6 minutes left here. I have a next question here, and this is kind of what we were talking about earlier. And I want you to just run with this, Sean. Okay, hit the home run here. This is an easy pitch. Knock this out. How many homes are they selling per subdivision or per neighborhood? Is it just 2 or 3? And is it to manipulate the tax assessment for the next year's property taxes? What do you think?
Yeah, so it is a few homes in each neighborhood, right? And that's one of the theories, is that they're doing it, like I mentioned, they have open appraisal protests on, all of these homes. So if they sell a few for less, that obviously would then give them a more compelling case to say, hey, lower my taxes on the other 25 on this street based on these two that I sold, right? So that's one possibility. I mean, you could also think about, and I'm not an accountant and definitely not a financial advisor, right? So just a little disclaimer, but if you think about it, I think other people have suggested, well, maybe this could be for write-offs, right? If you own all of these homes and now you're saying, okay, I had them on the books worth this amount, but I need the cash, or I need in some ways for this to hit my books so that I can write it off for whatever other reason, that could be one possibility as well. Or they could just need the cash, like you mentioned. I mean, there's been some really interesting articles, especially about, so First Key is owned by Cerberus, and their financials aren't, public like some other companies are. But, there's been some interesting articles, like Business Insider had an article about Blackstone REIT. And, they're sort of, they called it a house of cards, right? There's not a lot of transparency. How do you really value these assets? People are investing, and so really there's a lot of questions. And at the end of the day, I can't definitively say which one of these possibilities it is, but all I can say is it's pretty odd to sell some homes 2 years later at a discount when you just bought a bunch. It's clearly a reversal in strategy, and you're clearly either trying to manipulate something, or you're admitting that this was a bad investment. And we see the same thing by Fundrise. They're the one that, you can invest as little as $10 and have access to private equity like real estate investment. Well, they're selling 15 homes in a community in Austin now, right? Where they said they were going to buy all these homes, and they had these plans, and these plans were based on, hey, these are great places for migration and social distancing. Well, now they're pivoting. They originally planned, to buy many more. Now they're selling them. So all it says is that these companies are under pressure to make changes to their strategy. And
And
yeah.
Sean, what do you think? What do you think about this comment right here? There's been, and I understand both sides of the coin. Okay, so on one side of the coin, you have greed, corruption, and fraud from investors, and then on the other side of the coin, you have government regulation. Both are bad. Both are not good. And so this comment makes a lot of sense, and I respect it. And what they're saying is it's not a free market. It may seem like a free market, but it's not a free market. They're saying, I didn't say this. Don't be coming at me. Okay, I just want your opinion. Laws are needed. Again, there's some people said no laws. Jack just said it's going to correct itself. The more intervention, horrible. Just let this freaking thing bust and break, and let's reset and start healing together as a nation, right? But we got bad people in control of things. So what do you make of this comment, Sean, and what can be done to fix this?
Yeah, no, it's a valid point, and I certainly believe in consumer protections, right? And I think there's a middle ground as well. I know it's proposed, hey, maybe I think in the foreclosure space or auction space, there are sort of like periods of time, where certain entities are not able to bid for the first 30 days, as an example, right? Because there are individuals who benefit from being able to sell their home to an investor if no one else wants it, right? So I think there's a middle ground. I'm not saying, I already think we don't have a free market. And I think part of the problem here in a lot of ways, right? Because part of the problem here is I think these investors were responding to conditions that existed then that don't exist now. And that's the real story, if I had to summarize it, right? At the time, they couldn't really make anything in safe kind of fixed income investments. And so that's where they were going into real estate and trying to get returns that now you could get on a short-term treasury, right? And so I think in a lot of ways, this was created by, Fed policy, and things have changed to where now it's not an attractive environment for them to be buying anyway. I mean, if I, as an individual, if it's way cheaper for me to rent than buy right now, and I'm wanting to see that come back to equilibrium, well, it's clearly not good for them, situation for them to be continuing to invest. Because they're not making the money from it either, if that's the case. And not even to mention where rates are now if they were to go buy new properties. So, I mean, that's really the story to me. The fact that they're selling properties and not just holding is interesting as well, right? They could say, well, interest rates are higher, we just won't buy any new ones. The fact that they're selling is actually a reversal. It's not just holding steady to these new conditions.
And Sean, we got about 30 seconds left. Melody, Jack, do you have anything else for Sean before he goes?
Just on that last one, real quick, I think we have a chicken or the egg philosophical disagreement on it's not a free market, the laws are needed. I would say the reason it's not a free market is because of the laws. The laws are written by the powerful for the powerful, right? D.R. Horton, Lennar, all these firms that we were just talking about have an army of lobbyists for a reason. So any laws that we pass are going to be effectively written by the people we're trying to regulate away from manipulating the market. So I think that, again, more government intervention is not the solution to too much government intervention. That's just my opinion on that.
It's like that Corporate Transparency Act, right, Jack, that was supposed to, you're supposed to now, you can't, you have to be listed as a seller. You can't just be a trust. You have to know who's behind it. But who got a pass on that legislation? The big institutions. And so because the lobbying at the last minute. So.
Yeah.
All right. Well, hey, Sean, again, man, thank you for coming on our show, and good luck out there, brother.
Hey, thank you so much for having me. Y'all have a great rest of the week.
Any sign-off words, bro? I'm so sorry. Anything you want to end on before we let you go?
No, you already plugged. Hey, I'm going to be producing more content going further into this. So Ari Watchman, and I'm really grateful for the opportunity. Thank you.
All right, guys, and that, sir, is a wrap.